You can chat with me on the chat just for a minute, and then we just proceed to, yes, I can see a good morning, and someone is saying where they are watching us from. So you can also share where you are. It's also important for us to see where you are. And if this is your first time, karibu sana. We always do these webinars every month. We do a tax trends. We do a webinar, tax webinar for the month, a sector-based. This month we are talking about construction industry. I'm going to share the details. And then we also do another webinar on a different topic. And this month we'll be talking about KRA audits. Because after the massive filing that we did in June, around August, KRA goes through a process where they send letters of audits to our company. So I would want you to prepare yourself on audit. So that one, I'll also share the dates. We shall be doing it this month. I would love you to come so that you can understand the process of audit. What are they looking for? What are the audit triggers? And so many more, so that you well equipped. We say that tax is very revolving, it's very dynamic, and especially with the government that we are having today, the portion where they are really stressing on taxes, and so many changes happening at KRA. There are so many things that keep happening every single month. So even if today we are going to talk about the finance bill that was already passed. There's a time that we are talking about the proposal. Even if we not be talking about the finance bill, there are still more of items to talk about. Some of the taxes that will be proposed there will start being operational. So that's why we do this for the tax trends, so that you can know what is there, what is KRA talking about, what are they doing on their systems. They are doing a lot of system enhancement. Last month, we also talked about the pay simplified method. They rolled out a way to simplify how we file our pay. By there, you can go to the YouTube and watch some of those things, some of those trainings that we have done, so that you can up your game when it comes to taxes. So my name is Dr. Regina, and we are the leading LWK Africa. We are the leading company when it comes to tax trainings and this frontier of tax. And I would want you to follow our pages, LWK Africa. You can also follow my page. My pages, Dr. Regina King'ori, CPA-K. You're going to see on Facebook, LinkedIn. Anytime that we have a webinar, anytime that we have something, you can come in and learn something new and just understand what is going on for the benefit of your business. So I also have a YouTube channel. This particular webinar will also be channeled on that channel. On that channel, I talk about other things, especially on business, how to start, grow, and scale your business. So I'll talk about financial wellness and so many other topics. So I welcome you. So let's start. Before we start, I would want to ask you a question. What did you understand about the finance bill that was passed? What did you understand? What are the changes that you are able to see? What changes are affecting your industry? I would love to hear before I take you through it. So kindly chat with me. So we're going to understand the content for the day. We're going to understand the key provisions of the Finance Act. So from the bill is now an act. And so it's Finance Act 2025. We're going to see now, after the proposal, what was left out and what became to be. the Act. I'll talk about some few areas. I'll also examine major tax trends affecting business and individuals. I have a bit of that. I'll also analyze recent enforcement development. I'm saying that KRA is always on an enforcement mode. Remember, even when they were doing the finance bill, they say that this period of time, they will do a lot of compliance. So there's a lot of enforcement that is going on. I'll talk about that. Highlight implication and action points for taxpayers. So what is expected of you when it comes to those changes? What is expected of you and your business? So I'll talk about that. Meanwhile, as I go, also I'll talk about that. I hope you can be able to see, my notes. So if you can be able to see my notes, you can share, yes? Just share, yes. So Finance Act 2025. Okay, I can see a yes. So Finance Act 2025, just tell me what you know. Ama, we went with the notion that it is not introducing new taxes. That was a narrative that we were given, that it's not introducing new taxes. Losses now expire after 5 years. You're going to see about that. Thank you, Phoebe. All right, as you write, let's proceed because of the time. So we had on the bill, we had some proposals now which are at the Act. One of it was the per diem. That was very key. The per diem limit increased from 2,000 to 10,000 per day. So that was enacted. And now you can receive, if you're an employee, you can receive 3,000, 5,000 per day. And it can be termed as, it cannot be charged taxes. So it's a per diem. The shift was quite high from 2,000 to 10,000 per day. But it is a very welcome move. Digital economy, the digital asset tax has been abolished. So this was a tax that was introduced 3 or 4 years ago, especially to handle the digital businesses. But there has been an issue about implication and applications. Who do we apply this DAT to? Which kind of a company? So it has not been enforced. So it has been abolished, but instead they've been able to bring another one that is called significant economic presence tax. I'm going to talk about that. So the excise duty at 10% now applies to fees charged by the platform for digital asset transfer. So if you transfer a digital asset, this is cryptocurrency and those ones, Bitcoins, if that transfer of digital asset, there shall be an excise duty of 10%. So when it comes to the significant economic presence tax, this tax, which is replacing the digital asset tax, this means that we are having a company that has significant presence in Kenya. They might not be having a physical office, but they are doing their business digitally. Most of they are digital business. So possibly, let me quote a business like Uber, although I don't know if they have a physical office in Kenya, and they are significantly in Kenya. So that company is supposed to be termed as a company in Kenya and pay the corporation tax. So non-resident earning less than 5 million are no longer exempted. So the first time when it was introduced, it says that if you earning 5 million and below, you are exempted, but now there's no exemption. That is it. For other digital businesses, and because it's a question that we get most of the time, oh, I'm doing online business, I'm selling online, or I'm training online, and you think that that is a digital business, it's still okay. But when you're operating in Kenya, because you still invoice, you still get your money, it is important to operate that business as a normal business and pay corporation tax. So you look at your sales, you look at your expenses. Even if you're selling that product online, at the end of the day, there was an invoice provided or a receipt that that item was for 5,000 and these were my costs, and you operate it as a normal business and file the correct taxes. So there's also some exemption that has been provided, income tax. So this is something new that has been introduced. Nairobi International Financial Center incentives. This is a move to be able to welcome investors in the country. So for startups certified by NIFC, there's a corporation tax the corporation tax is reduced to 15%, so by half, from 30 to 15 for 3 years and 20% for 4 years. But before you say, I want to be here, there are qualifications. So for qualified investment companies, there's a 15% for 10 years, that is a corporation tax, then 20% for 10 years. But the investment has to be at least Kenya shillings 3 billion within the 3 years. So this is an incentive, the way we get the EPZ that is able to attract companies to come and operate in Kenya, but they are doing export and be given spaces in Kenya to do their business, and they get very good tax rebates because they're operating in Kenya. They are just operating. They are not even selling their product in Kenya, the EPZ, but they come, they employ people, they grow the economy of the people. So the same way that you are getting this, that you come with that investment of 3 billion within 3 years, then there are some tax remedies that you're going to enjoy. So 70%, there is also another qualification that 70% of senior management are Kenyan citizen. You have to employ Kenyans. Kenya is a regional headquarters, so you must have offices in Kenya. And then dividend reinvested relief. So after you do the business and you have dividends that you need to share, and instead of taking the dividend back to your country, you can reinvest those dividends in the country. So if you reinvest those dividends, 250 million and above, it is exempted from tax. So this is an incentive, especially for investors who are coming to our country. Let's continue. Income tax. We also have investment allowances. Spectrum license cost for telecommunication now qualify for investment deduction at 10% per year. So any telecommunication company, these are companies that are doing communication like TVs and radios, that license is very expensive. So the moment you're licensed, because of that expenditure, is a very high capital expenditure, that expenditure is now welcome for an investment deduction, 10% per year. So this you can you can do for years, and it can be able to save on taxes. Betting and gaming tax. Withholding tax of 5% now applies to wallet withdrawals, not just winnings. Every year for any finance act, there's always something about betting. Possibly it's because it's an industry that I don't know if it is growing, or is that we are doing a lot of betting. It is saying that when you win, there's a 5% withholding that should be happening. And by the way, if you've been winning, you can tell us. You can tell us what, if you've been getting this. And if you do wallet withdrawals, I'm imagining wallet withdrawals is at you win 5,000, so you withdraw like 2,000. Even that withdraw of 2,000, and you still pay the withholding 5%. So the withholding, the company, the betting company is supposed to withhold and pay KRA. So if you're doing any betting, there's a lot of, this is withholding that has been introduced. We have excise tax, which I'm going to mention next. When you place the money there, it is there's excise tax that is also levied. So betting, sometimes there are a lot of taxes around it. So for any person that is doing that, you can tell us how the statement, I don't know if they give you a statement, how your statement looks like, because it should be having excise, it should be also be having the withholding tax. We also have capital gain tax, CGT. Only licensed entities in special economic zones are CGT exempted. So if you are an organization operating the special economic zone and you're licensed and you have a property there, in case you do want to release that property, you are CGT exempted. Transfer of property to a family-owned company where the transferor is sole shareholder, now CGT exempted. So this is something that has been there, but I'm happy that is able to be documented properly. So if a transfer from a family-owned company, so for instance, company A, that is owned by Regina, where the transfer of property to a family-owned company, where the transferor is a sole proprietor. You can transfer that property from company A where I'm the sole shareholder to company B, where I'm the sole shareholder. And you may ask, why are you transferring the property from one company to the other, where you're just the one who is a director? It happens in so many cases. You might be having a property, you've closed down the company, you want to open another new company, you want to transfer that property so that possibly you can get a loan or something else. That process is now CGT exempted. It has been, but it's very good to be documented. Income tax, if you don't understand something, you can write on the chat. You can ask me a question and I'm going to answer your question. So other deductions, construction costs for sports facility on public grounds are now tax deductible. So this means that with their tax deductible, they lower your profits so that you pay lower taxes. So construction costs for sports facility. I don't know, when I looked at this, I thought, of course, sports facility of public grounds, you imagine it is the government or the county government that is doing this. But if you're an organization and you volunteer or you want to do this construction, possibly to help the community about sports, that money that you spend, you can term it as an allowable expense, and you can be able to lower your taxes. Value added tax. So value added tax. So they are new VAT charges, 16%. So some previous exempted items now are subject to standard VAT rate, which is 16%. And we mentioned the difference when I was doing the bill. I mentioned the difference between standard rated, exempt, and zero rated, which I'm going to mention again so that you can understand the difference. So when something is 16%, or that is a standard rated 16%, it means it means you buy with VAT and you sell with VAT. So at the point where you're doing your return, you pay VAT on the value added. For instance, you buy a bag of cement, you charge 16%, you bring to your shop, you sell it with 16%. But when you bring it to your shop, you add like 100 shillings. So at the end of the day, when you come in to file your VAT, the sell and the purchase, the difference, which is your profit margin, the 100, is what you're going to pay 16% on. And when we talk about VAT, there are so many people who get confused about VAT, especially where we have a manufacturer, we have a distributor, a wholesaler, retailer, somebody else in the middle. So sometimes people will confuse and say that this product is overtaxed. When it comes to VAT, there's nothing that is overtaxed or double taxation at any particular point, even if that items is moving to 10 people before it gets to the final consumer, there's nowhere there's double taxation. It's only that the moment you add value, adding value is your profit margin, you pay VAT on that. The next point, you pay VAT on that. The only place where you lose is a place where you don't have input VAT, or that purchases VAT, you don't have it. So that is a place where you might lose. But at the moment you're having e-teams that is flowing all these channels, there is no double taxation. So that is 16%, which is standard rated. We have exempt. So when it comes to exempt, so this item, this bag of cement, when it comes to exempt, you buy it with 16%, but when you come to sell it, most of the time you find that this product is like a raw material of something else that you're coming to work on. So when you bring to your factory, it's not like a retailer where you just sell it. No. When you bring to the factory, you remove it, you add other product, and now it becomes a different product. And possibly that different product is exempted from VAT. So it means that your purchase had VAT, but your sale does not have VAT. At that particular point, because it's exempted, your sale is exempted, this cost of VAT at the point of purchase, you just absorb it as cost. So that's 16%. If that bag was 700 plus 16%, for instance, 16 was 100. So the total cost was 800. When you're now coming to make the new product, you just absorb the 16% as cost, and there's no refund of that money. You sell your product as exempt. Why are items put under exemption? Is to make sure that the cost or the price that is going to the end consumer is a bit lower. So for instance, if this thing was mixed together and it's supposed now to cost 2,000, if you add 16%, it would possibly even cost 2,300 or 400. So it would be very expensive to the end consumer. But the moment it's exempted, it means that it will be sold at that 2,000, which is a lower and a cheaper price for the end consumer. So that is exempted. When it comes to zero rated, it means that the price of purchases, even if you bought something with VAT, at the point where you're selling, when the product is zero rated, these 16%, that we say that under exemption, you absorb it as cost. This 16% at the zero rated point, you can be able to ask for a refund. So you create a credit over the VAT filing, a credit, and then you apply for a refund. Why are some products exempted? Why are some products zero rated? So that the promotion, so that the industry, that industry can be promoted to grow. So there's because the refund is being refunded to this company that is operating zero rated items. to promote the growth of that industry. For instance, the export industry. So for exporters, because the government want to promote exports, they zero rate the industry. So for instance, if you're selling avocado, the price of cartons and anything that is VAT, anything that you bought with VAT, the cartons, the pallets, anything, you refunded that money. Of course, it is a way to promote the industry for it to be able to grow. So those are the terms. And when something is moving from exempt to standard rated, it means that something that was being sold at 2,000 without VAT, it's now added VAT. So that now the product is expensive at the end of the day, but the government is able to recover that 16%. So the end consumer pays a higher amount, and then that higher amount is paid to KRA. So previous exempted items now subjected to standard VAT rate, 16%. So this is input of geothermal oil and mining prospecting. So anything in that sector was exempted, of course, to promote those exemption mining, those geothermal and mining. Textile raw materials, and then we also have the disc and smart cards used in the healthcare services. There are VAT exemption introduced. So there are some introduction when it comes to the VAT. Why are they being introduced? To make sure that the product that is being sold, it is sold at a lower price for the benefit of the end consumer. So this is mosquito repellent, the final product. It is around the mosquito. Input raw material and machinery used in their production of those mosquito repellent. Services applied to mosquito repellent manufacturers. So it's in the industry of mosquito repellent, possibly to curb a bit of malaria. For VAT, also, we have the VAT refund on bad debts. So refund with widow reduced to 2 years from 3 years, speeding up tax recovery for suppliers. So how do VAT refund on bad debts come to be? And previously would request for those refunds after 3 years. Of course, there is a lot of documentation that is required. First of all, how do we get those refunds from bad debts? It means you sold something with ITIMS or ETR. And for instance, you made an invoice to a customer. They were supposed to pay 1 million. You did an invoice and you gave them the invoice. Then this 16%, remember for you, this is a sale. For you, that sale that you did, especially right now, because we are using ITIMS, and ITIMS is auto-populating, whether you are paid or not, it will just auto-populate. The moment you key in details of the invoice, for instance, the customer tells me, give me an invoice. After you give me the invoice, I'll pay you. So you do an invoice of 1 million. It is this month. The customer pays you next month. At the end of this month, when you be doing your VAT, it will auto-populate telling you you sold goods worth 1 million and you've not been paid. So it will require you to pay for that VAT and you've not been paid. So that's what happens. So you end up paying VAT on bad debts, on customers who will not eventually pay you. So you can have those calculations of all those VAT and you can request for a refund. Of course, requesting for a refund is a tax trigger. So you have to be very neat when it comes to your work. So you have to demonstrate the sale, demonstrate you try to recover the amount of money. VAT refund is a very